You have questions on like-kind exchanges, one of the classic tools available to owners of investment property and businesses. Hi, Bob Jennings here. Let's try to answer some of those questions for you. Let's start by emphasizing a like-kind exchange is a way to defer income tax. You don't avoid paying it, you put it off for a period of time. Second, a like-kind exchange may only be accomplished with business or investment property. It does not apply to your personal residence, to cars, to investments in stocks, bonds, mutual funds, or collectibles. Only business or investment property. Equipment, land, buildings generally is what we're talking about. All right, so with business or investment property, here's the concept. If I fall into the one of four types of like-kind exchanges available, I will not pay tax on whatever's involved. Okay, so let's see. If I do a like-kind exchange that meets one of the four categories, I don't have to pay tax. What if I trade my property and give more money? I don't have to pay tax. You already then understand the advantage of a like-kind exchange. Let's try to clarify this for you. But before we do, we get two other definitions out of the way. You know, a like-kind exchange is not always a good idea. Right now, we're looking at highly increased income tax rates in the future years. Generally, when you're looking at higher income tax rates in the future than you are at the present, it may not be a good idea to do a like-kind exchange. Talk to your tax advisor for further information about that, but they're not always the wisest thing to do that. Secondly, we need to understand what the definition is of a like-kind asset. If you are trading real estate for any other form of real estate, that qualifies. What do you mean? You know, I've done like-kind exchanges. I've been a CPA for 30 years. I've seen exchanges involving raw farmland being traded for an apartment building. Does that qualify for this tax-deferred treatment? Yes, it does. Any form of unimproved or improved business or investment real estate for any form of improved or unimproved business or investment real estate will qualify for the tax-free treatment. What if we're talking about equipment? Now, that's a whole lot tougher. That one is tough enough. I really can't get into it. You have to talk to your tax professional. You're trading a pickup for a pickup, that's okay. But if you're trading a heavy-duty pickup for a light-duty automobile, you may have some issues here. You need to talk to your tax professional. Okay, so we got all the careful definitions out of the way. What are the four types of like-kind exchanges? The most common like-kind exchange is just called a trade. It's where you trade your pickup truck on one other pickup truck. Is there any tax involved? Unless you receive cash, no. And you need to remember that, folks. In a like-kind exchange, if you get something coming back to you, it's called boot. Or think of it this way. If you trade your truck for another truck and they give you cash back, you're going to pay tax on it. But if you give your truck for another truck, even there's no tax. Or if you give your truck for another truck and you pay out cash, there's no tax. If you receive cash, you're going to have to pay tax on that one. Now, the trade is a great idea and it works on trucks, but it doesn't work very often on real estate. The most common type of like-kind exchange is the second type. It goes by many names, and I'm going to try to give you all of them. The second type is called a delayed exchange. Now, a delayed exchange can sometimes be called a deferred exchange or a starker exchange. They all mean the same thing. Here's how it works. Let's say that I own a business property right here in Miami Beach, Florida. I sell that property today, and let's say I make $200,000 on the deal. Now, if I sell that property today and I make $200,000, I'm going to have to pay Uncle Sam some tax. However, here is how a delayed or a deferred or starker exchange works. At the closing, instead of the check being out to me, it's made out to a trustee. This is someone who's called an intermediary. The trustee holds my money for me, and then I have two other rules that I have to meet. Within 45 days, I have to tell the trustee, hey, I'm looking at this property and this property and this property. I have to identify where I'm going to put my money. And B, within 180 days, I need to get closed on some other type of business property. A delayed, deferred, or starker exchange has three simple rules. I may sell my property for cash, pay no tax today as long as A, the money goes to a trustee, not to me. B, within 45 days, I identify some alternative investments. And C, within 180 days, I actually get closed on some alternative real estate investment. That's the most common type of like-kind exchange. The third type of like-kind exchange is called a build-to-suit exchange. These are extremely rare. In 30 years of practice as a CPA, I've only seen one. Why are they extremely rare? Because you can't build on property you already own. It's a very difficult thing to get done. You need to talk to a tax professional. But if you're thinking, hey, I've already got this building over here, I'm going to sell this building I've got here and take the cash and improve. Folks, that ain't going to work. That's not a build-to-suit. Talk to your tax professional. Now, the fourth type of like-kind exchange is a relatively newcomer. It's about 8 or 10 years old. It came out in the year 2000, and it's called a reverse exchange. And a reverse exchange goes opposite of what we had with the deferred exchange. Remember the big one, the delayed or the deferred or the starker? I sold my property and then I bought new property. Well, the reverse exchange goes the other way. It says, I can go ahead and buy my new property today, put my old property on the market, and as long as within 45 days I identify which of my old properties I'm going to sell, and within 180 days I get it sold, I can treat it as if I've backwards invested that money in a reverse exchange. So a reverse exchange allows me to buy the new property before I've sold the old property, and basically I have to have the old property sold in 180 days, and I don't have to pay tax on the deal. A like-kind exchange, let's summarize. Business or investment property. It allows you to defer the profit by reinvesting that money in like-kind business or investment property. It's not always a good idea. There are 4 types, of which the main 2 are the delayed, deferred, or starker, and the reverse. The delayed, deferred, or starker says, sell my property today, take the cash, within 45 days identify new ones, and in 180 days get closed. In the reverse, go ahead and buy the new property and get my old one sold within 180 days. Tough topic, wasn't it? Well, folks, for further information, please visit us at our website at the bottom of your screen, or feel free to give us a call. Bob Jennings, thanking you again for listening.